Good morning. It's 5:49 Pacific Standard Time. Stock market's going to open up in 40 minutes. And I have a monthly call chart here on Google. And basically, it's a 560 call option that was deep in the money. And here, I'm going to show that they've never been this low. Now they're really going to be deflated on the bottom end. Google reported a great earnings. They beat by 29 cents a share. They did not miss on the bottom line. The bottom line was the biggest beat. The revenue structure was tremendously as well, based on their rollout and their product line. So we view this as probably one of the golden opportunities in short-term trading. We own some calls that go out 12 months from now. And we're still very confident we're not going to be selling out and losing money on those calls because they're going over the next several quarters. We're going to do well. And basically, short-term trading, the call options, and if we are in a trading range of $20 up and $20 down for a while, we will also tell you in this tape on the options trading that now you're going to get down into the February contracts and even the March contracts that were deep in the money, that are not going to be deep in the money. They're going to take all that premium out, and those contracts are going to get an all-time deflated low, and they're going to bounce off their bottom. So we're going to be looking at the 560 call. That's this one here. We've got an alarm set. We're going to be looking at the ranges. We're going to be looking at this 550 call. That was $43. Calls that nobody thought they could ever buy again. But they're going to be buyable, and they're going to be tradable. And the February contract will be the one that gets the most damage because it's next month's options expiration. So we're going to be looking at the 570 call here, which is $29.40, $29.90. We're going to see if we can't pick these up at $10.50. And then they move back to $18 and we sell them. This is how you add revenue and trade a position that falls in after hours and was manipulated like so many of them have. Whether it was IBM, whether it was Intel, whether it was Goldman Sachs yesterday, dropping from 171 down to 156 with one of their blockbuster earning reports. We've gotten blockbuster numbers out of the company. It's not an issue of fundamentals. It's one of the things that these stock markets do at times is they'll to buy. Okay? They don't want to buy them up here at 29. They're damn sure going to buy them down here at $10.50. And then they're going to move back forward because the contracts are going to be totally deflated. So there's the 570. Here's the 560. And we're going to watch and see what happens. And the people who have the buying power are going to end up getting great intraday trades. There'll probably be a minimum of 2 to 3 trades per week in the February contracts that are going to be. We love it when they're deflated. That's when you want to buy them. This very contract, that 550 call, you can see up here it was $80 a contract. It's been cut in half. Wall Street loves to create events or hysterical moments to drop prices so that they can get their greedy hands on the purchases. Whereas the general public and maybe some financial advisors or mutual funds or whatever, they'll just be consumed by emotion. They'll be looking back saying, man, that was the greatest buying opportunity. That's what happens in these kinds of incidences. And that's exactly where we're going to be. And last night's swing low, which we recorded, it's on YouTube, hit 560. We bought some stuff. I'm going to be showing people here that the monthly buy signal is still in play. That isn't changing. And basically, I'm going to draw a trend line here on the monthly chart. This is the 550 handle, slightly above it, of this last 2-month bar. The 20-week simple moving average on Google, as I said over the weekend, that people could buy 550 puts if they wanted because that was the 20-week moving average. And we hit that. We are right now, as it appears to me, where the bids are is that we're going to come down and we're going to test this rising 20-week moving average. So it's all about today and moving forward as to what we do here and what kind of a bounce we get. And not only that, before we go into the marketplace, I'm going to show people that on the percent DS weekly, we're at 70.84. When we were at the highs up here, we were at 96. Now we're at 70, and now this is probably going to drop down to somewhere like around in the mid-50s. So is it going to be overbought relative to those great earnings? Absolutely not, because it's not. And we will take advantage of it. Not just one trade, several trades looking forward. That's the way that the Google is going to be, and I'll upload the chart. That's the chart. That's the 20-week moving average. We're just going to see today on the percent DS down here, we got 26 points below it. We are not really on the weekly. How much more could you ask for other than it's going to work off all of that overbought capacity level off? And we will do some formulas now because we're going to really have a mathematical formula that we're going to have to change from this 52-week high in January to the low, just like we did last year in this very same crappy 4-day period, just an identical retake of what was happening last year.